This has been a tumultuous quarter to get started. We've got so many things going on and a lot to talk about. I'd like to welcome Jake, the man with a plan, recent CFA, and our partner in crime when we do these economic reviews. Our theme today is adaptive trellis. And the idea is that we all want to grow great fruit. And in this instance, the fruit is our investment portfolios. And the idea is that if you're going to grow great fruit, you have to have a good stock, a good substance that you're working with, and you have to control the growth. You have to have structure, rules that you can employ that will give you a great chance of having success. Right now, there's a ton of uncertainty in the markets and in the economy. So we think it's really important to go back to basics and look at our rules for investing. So today, what you're going to hear is what's going on in the economy and a little bit about what we're doing in our portfolios and recommending for people. You have to start with a good trunk. In other words, there's never a great time to speculate and buy junk. And then we need to be prepared for really different types of weather. We're going to lay out the case, and everything in investing is probabilities, that things could get really hot and things could get really cold, and your grapes are going to need to survive both. And then, what does a vintner do? What are the strategies and techniques that a good vine maker or winemaker needs to pay attention to? So starting in COVID, we came up with this process that we call the street signs. And the idea is that it's supposed to lay out kind of a base case of what we think will probably happen or what economists are expecting. But it's like you're traveling down the road and you don't know your ultimate destination, which we don't. And so what would be the signs that would point towards either positive things or negative things? And so Jake, why don't you walk us through our up-to-date street signs for 2025?
Yeah, absolutely. And as Scott mentioned in this segment, we take a look at different market scenarios that we can find ourselves in. What's really important to note is that at the end of the day, we're forecasters and we're not predictors.
Right.
And what that allows us to do is, number one, we don't tie ourselves to any sort of outcome or number. And we don't predict that the market's going to end here or there.
Because then you start trying to find information that backs your position.
Absolutely.
And that's where people get in trouble.
And so instead what we do is we try to model in different scenarios. As Scott mentioned, our base case points the S&P 500 to be right around 5,900 to 6,400. And if we look at where the market closed today, right around 6,100, that doesn't give a lot of wiggle room towards the upside.
Yeah.
And what we use to model in this base case is we take into account Wall Street analyst earnings expectations for the next year, and we use a reasonable price to earnings ratio. And then what we do from that point is model out both better and worse scenarios. And so on the downside, looking at hard landing or stagflation, we could expect there some contractionary economic conditions. Maybe growth slows and inflation heats up again.
Yep.
There's contractionary or restrictive monetary policy. Maybe there is geopolitical uprise or heat on that standpoint as well. Whereas to the upside, we have soft landing and growth returns. What we would expect there is the opposite. Conditions that are sunshine, if we're talking about the weather, where growth returns from a GDP standpoint, corporate earnings maybe increase and outpace expectations, and consumer sentiment is at a higher level, which points to maybe a higher price to earnings or valuation level. And so as Scott alluded to, we're driving down the road, we have to keep a close eye on the signs to watch. We think that these are the key macroeconomic drivers for risk and return over the next year. And you can see that we intentionally left number one and number two blank, because what we know in doing this for the last couple of years, and Scott, you for a lot longer than me, is that
we have to throw that in.
is that we look back in time and there will be things that are plainly obvious in hindsight. And especially as it comes to predicting drivers of risk, there's always going to be one or two things that really drive the markets that nobody saw coming. Could have been COVID in 2020, for example.
Could be bird flu, for example.
That's right.
There's so many. There's geopolitical things, and there'll be something, again, that's perfectly obvious in hindsight.
What we do know is that there are obvious drivers that the market is somewhat uncertain about. And that could be Trump 2.0. We get this second round. There's a lot on the table, and there's a lot of headlines being stirred around that.
We've had a decades worth of policy changes in the first 20 days.
It's unprecedented.
It is unprecedented.
There's also the Federal Reserve. The Fed right now is wrestling with inflation that's sticky, and we'll get into that, but also they have a dual mandate with the labor market as well. Ultimately, what they do and where interest rates go will have a big impact on the stock market, we believe. And we'll get into some of the other items. Consumer strength is always going to be important. We're a consumption economy. And corporate earnings and profit margins, where those go. We'll get into some of these signs to watch later on in the deck, but of course it all starts with the Federal Reserve, right, Scott?
Right, and just be aware that the theme again is that if you got good stuff and you have a solid growth structure, the weather can be hot, the weather can be cold, you're going to be okay. What you don't want to do is rip the vine out and keep looking at it too much, because that's when you get into trouble. But let's dive into probably the number one thing, and we think is probably the most likely negative surprise is inflation. So what you see in this graph is you see the green line, which represents what the market expects the Fed to do with their rate decreases. About a year ago, maybe 8 months ago, the Fed was saying that they expected 5 rate decreases this year. They gave, as you can see, 0.5% and then 0.25% decreases. And now they're saying probably that may be it.
Yeah.
The market is saying that. Now the Fed is saying, no, we're going to be able to decrease interest rates. So if the Fed feels that inflation is too strong, they're going to not decrease interest rates. And we see a lot of inflationary pressures percolating in the markets. And we'll get into some of those right now. One is the different components of inflation. And the dark blue there is housing.
Yep.
So, Jake, explain what owner's equivalent rent is and how crazy this statistic can be.
Sure. When we all think of CPI and inflation, a lot of times we think about like the grocery store effect and sort of
eggs,
milk, things that you're buying every day increasing in price. Shelter, a large component, about 2/3 of shelter CPI or inflation is coming by owner's equivalent rent. And that right there is just if you own your primary residence and you live there, it's what you could theoretically rent your house at.
Right.
And so that's not actually a real cost at all.
Right.
And so it's a little bit misleading. And what we typically have seen is that it's slower to react than real-time rent data, which we'll get into housing market, especially in our area. But we could see that rents, broadly speaking, have flatlined. But that's still a major component of the total CPI.
Yeah, so we'll look at multifamily housing, and we are seeing rents come down. But when you talk to people in the business, they'll argue that there's been I always call it a pig and a snake. When a snake swallows a pig, there's this big lump. There's a big lump of new housing starts, specifically multifamily housing. You can see it around Venice, Florida. There's all these places, that popped up. We haven't had an apartment built in 2 decades, and now we have 20 being built in 2 years.
Sure.
But once that supply gets out, there hasn't been any new permitting. And when you have housing prices remaining high and interest rates remaining high, that's been frozen.
Yep.
However, anecdotally, we've been talking to realtors, at least in our area, in Charlotte County, we're starting to see housing prices start to come down. So there's a possibility, but unless housing prices, rents start to break, this part of inflation is going to remain really high. Food costs are going up, and then auto insurance, because of disasters and other reasons, has been another component of inflation that's been really sticky. Then you have energy, which when you look at this graph, you'll see some going below the zero line. That means that like energy prices were $80 a barrel, and then they're $60. But they're not likely to go to 40.
Right.
So you have that element that was pulling inflation down that's going away, and the other elements are remaining high. So we think inflation could be stubbornly high.
Yeah.
And then next we look at another huge component of inflation is labor demand.
So it's the other side of the balance that the Fed's trying to maintain, stable pricing and full employment. And what we're seeing on the labor side is kind of a return to normalcy from what we saw before COVID.
Right.
And if we look at job openings, have pulled back, and that trend from March of 2022.
That's on the left. You see the job openings dropping, right?
Yeah, and that's if you just look at that in a vacuum, that's really bad.
Yeah.
And the Fed, we got a couple bad jobs reports, and the Fed had a loose policy or a where they brought the rate down a little bit. But now we're sort of returning to just what we saw before COVID, which is a good spot from an employment standpoint. And also the quits ratio, again, right around to what we saw pre-COVID. It didn't drop well below that. And so the employment market's relatively in a good spot, whereas inflation's remaining more and more stubborn. Again, maybe pointing to why the market's expecting not as many decreases as the Fed's projecting.
Yeah, one of the big components with employment is workforce participation, which we'll talk about, immigration, and the strength of the economy. So what you're seeing here is that the employment numbers are starting to soften a little bit. And then this next chart shows unemployment and wages. So for the first time, we've seen wages grow, and wage growth has been better than inflation. So that's a real positive for American workers. But you can see that those are coming up to a kind of a crossover point. So that has been a big positive. But you're seeing that wage growth start to slow. And then labor supply. So I've got my own theories on this, but if you look at the sources of labor, you have to have positive birth rates, which isn't happening.
Right.
It hasn't been happening for a while. And that's in Europe, China, Japan, every place but basically India, and of course America. And then one thing that we've had is we've had a lot of immigration.
Sure.
And that is reversing.
Yeah.
And the thing about immigration is you have a triangle of jobs. You have high paid, highly compensated, few people are on top, and you got this lower tranche, which is really low wage workers. That's the immigration issue, and that's being zapped. Now in Florida, it hasn't been so bad because DeSantis had, what was it, 2 years ago, that website that if you're hiring somebody, you got to put them on there. And so we've been dealing with this. And so we don't have as much of that problem as elsewhere. And we don't know the actual number that it's going to be. It's certainly been a visible sign, and we've seen a stopping of new immigrants coming over. But we don't know what that's going to do to folks like landscapers and restaurateurs and others that are employing people that may be no longer here to employ.
Yeah.
So that's going to have some cost push to the inflation numbers. But if you look at workforce participation, since COVID, the number of older workers in the workforce have really dropped down. And I'm not even a baby boomer. Maybe I'm right there on the corner or on the edge of one. But I know a lot of my peers are like, listen, I'm sick, or people are sick and dying, and I'm going to go out and live life. And so that's helping keep labor costs down, or the supply of labor is not as high because there's not as many older people working,
right?
Which wasn't the case, and it's just kind of the bubble of baby boomers working their way through that. Next, you see GDP. I tell you what, earnings and GDP has been great. I mean, it has been a surprise. Positive earnings coming in. GDP has been positive. So this economy continues to perform really well. Now that's a backward-looking statistic, but it's strong, and it's showing in the GDP numbers. This is something that I think is really interesting because it talks about local markets, so multifamily housing. Jake, you want to take that?
Sure. So what we did here is we got some data from CoStar Realty that takes a look at the Sarasota markets on both. We'll talk about multifamily as well as office too.
Commercial.
And what we've been told here, especially by real estate developers, right, is you want to be in multifamily, you want to stay away from office, right? That's been truly since COVID, the pounding of the table. And what's interesting here is in the Sarasota markets, what we've seen in multifamily is somewhat alarming. We've seen the under construction units fall by almost 50% year over year. That in itself is concerning, but also looking at vacancy rates, up to 14%, up over 5.5% year over year. And that's somewhat astonishing, leading to occupancy that's among the lowest that we've seen kind of on the all-time average that goes back to the early 2000s.
So that would be disinflationary because they're going to have to start lowering rents.
Right.
To get people enticed to come in. So interesting, that's a statistic, and it's just one, and maybe that's not par for the nation, but I think it is. There's been a big glut of these buildings.
Well, what's also interesting too, staying on that chart, is that we really haven't seen market prices budge all that much.
Right.
Whether you look at the average home per sale or price per square foot, that's really up towards kind of the all-time high in that data range as well. And so those two forces, they don't really sing the same tone there.
I always call it the Wile E. Coyote moment in markets, where the coyote runs off the cliff and his legs going like this and he looks down and then he falls. So, markets can withstand, especially when you've got big private equity in the marketplace, and they'll keep prices high, but then at some point the dam breaks and prices will correct. So something that is unsustainable is unsustainable. So here you see office and retail, and these are things that you would think were horrible,
right.
But what are the stats telling us?
Well, yeah, the stats show us pretty reasonable numbers in terms of units under construction for both of these in the Sarasota market, right? Being up over 5% year over year. We're also seeing really strong rents, and even more surprisingly to some would be vacancy rates near the all-time lows.
Right.
And so you see strong rents, low vacancy rates. I mean, these are really strong numbers for office and retail.
So what's happened is the market has reacted, that there was, people are shopping online and there's no need for retail, and then so they don't build any of it.
Yep.
And then they do still need it. I mean, when you have a housing development, you're going to need a Publix, you're going to need certain things, nail salon, etc. So anyway, it's interesting that's actually been pretty strong, and the office has been pretty strong. Let's get back to consumer finances. We're starting to see some cracks. So on the left-hand side, you see the assets of the average consumer, or of American consumers. And I can remember back in the global financial crisis where we had as much in liabilities as we did in assets. We're nowhere close to that now. People just don't carry the kind of debt that they did 15 years ago. So I don't think we're going to be running into the kind of problems that we had during the global financial crisis. But on the right-hand side, you're starting to see some cracks, especially in what I call the Dollar General part of our economy. These are the lower income folks. You can see delinquency on credit cards and consumer financial things. And what's that telling us from an economics perspective, Jake?
Well, that at the end of the day sort of trickles into discretionary spend. And if we have consumers who are defaulting on credit card or auto loans, that's going to mean that those people are, for the most part, going to not shop and spend at Nike, Adidas, or whatever it might be. Maybe it's Apple and getting the new iPhone. At the end of the day, we're seeing strong balance sheets from consumers, probably largely driven by the baby boomer,
right?
And they're still spending, and so that top end is keeping things afloat. But what we're seeing on the lower income scale is not the same tune, and we're a little bit concerned about that.
Yeah, I'd be curious to see if the restaurants start to peak, because restaurant food costs have been just enormous.
Sure.
And you can't even go out and get an egg sandwich anymore without having a lot of expense. But so anyway, there are some definite cost push elements in inflation. This is the federal finances, and I think it really is the dam by the vineyard. So what we mean by that is this is the thing that could flood us, and we need to be paying careful attention. But I have to admit, I've been calling this story for a long time, is that at some point, the government debt and the service on the debt will start to squeeze out everything else. And it's kind of like, do we want to have a bunch of little forest fires, or let the kindling build and have a forest fire that's uncontrollable? But the government deficit, as you can see on the bottom right, is the red line assumes that the Tax Cuts and Jobs Act of 2017 under the first Trump administration, that those tax cuts get expended. So even with all the talk of DOGE and cutting of government spending, the projections are that government spending and the deficit are going to go up and away. One of the big reasons is that interest on the debt. So Jake, comments?
Yeah, and that's where you look at to the left side of this chart here, looking at the federal budget. We've got our income on the right side, and we've got our spending on the left side. And what we've seen consistently grow on that left side, cash outflows that we're spending on, is net interest on our debt. and it's up to 15% now.
Jeez.
And I mean, if we looked at that number just a mere 2-3 years ago, I mean, we were well below 10%, even 5% range for that.
Yeah, especially when interest rates were at zero. You could have an unlimited amount of money.
Right.
At zero interest, you're paying zero interest.
Absolutely. And so that's obviously a huge concern as that continues to get larger and larger. Interest rates unlikely to probably come down by a great deal, especially if there are concerns about our ability to pay back our debt.
Right.
That could mean that the natural floor for interest rates is higher and higher too. And so that's obviously a concern.
So one of the things that we're watching close is the amount of pressure that the Federal Reserve gets from the White House. Now, Bissett, the new Treasury Secretary, says that they're not going to browbeat Powell. Powell says that he won't be influenced by it, but we'll see. So the Fed can, they can issue bonds or actually print money and buy bonds, which is the same as issuing them, or they can just keep lowering interest rates, but they've got to keep inflation under control. So dual mandate. What one of our fears is that is kind of symbolized by this graph. So what you'll see is the blue, where we map out those Fed discount rate cuts like we were mentioning earlier. And then the goldenrod is the line of the 10-year Treasury. So logic would have it, hey, if the Federal Reserve, which controls the interest rate that banks can borrow from, if they lower interest rates, then the yields, what it costs to borrow for a 2-year note, a 3-year note, a 10-year note are all going to go down.
Sure.
And of course, the mortgage rates are set based on the 10-year Treasury. But what's happened is since the Fed started lowering interest rates, the 10-year Treasury has actually gone the other direction. So the Fed lowered interest rates by 75 basis points. The 10-year Treasury yield went up 100 basis points. So why would that be? The answer is that the Treasury bonds are set in an auction process. The Federal Reserve comes out and says, we need to borrow $1 trillion, and a bunch of buyers comes in and say, okay, I'll loan it to you for this amount and this amount. And obviously the lowest offer or the highest cost wins. And what's happening is people are saying, I'm not that interested in loaning you money, and so you have to pay me more and more and more. So you're seeing those rates creep up, and it is a real problem because that's where all of the economics of interest rates come through. Not all, but a great majority of them. As I mentioned, the cost to borrow money is huge, and it also shows the confidence of what's going on. If you see interest rates start to go higher and higher and higher in the market, the Fed can't very well lower interest rates. They're going to have to follow the market. So
right.
Who controls what? Back in the 90s, Bill Clinton would be so angry, he called them the bond market vigilantes. And that's when the government spent too much and the bond market would punish them by driving yields up. And we're starting to see that happen now. And that's something that we got to keep a close eye on. Because as those 10-year Treasury yields go up, what happens to our government debt? Continue to go
up and up.
Right. Yeah. So not good news there. What about the stock market? Oh, I'm sorry. One last comment on this is the yield curve. I know it's one of my favorites. But what we've seen for the first time is in a long time, we used to have interest rates on the short-term part of the Treasury be higher than the long-term, which was a sign of a coming recession. That's gone the other direction. Does it mean that we're not going to have a recession? No. But it just means that the market is expecting higher inflation.
Yeah.
Or it could be anticipating. It could mean a lot of things because it has also to do with the trade deficits and what's happening there. Obviously, if we have a large trade deficit, that's putting negative pressure on the dollar. And if we're doing something to reduce imports, it's going to be a positive thing on the dollar. That creates inflation.
Yeah. Because
it creates imports that are more expensive, and it just is around and around. It's so many different complications. And it all kind of fits into that Treasury yield, I think. So that's one of the key things to look at. This is S&P 500 and valuations. Jake?
Well, what's so interesting about it as we go from the fixed income side to the equity side is we just talked about all of this bad news being priced into the bond market.
Right.
It's all bad. None of it's good. However, if we look at the equity side, all the good news is being priced into the stock market.
Yeah.
And so we're getting lofty expectations right now. And what I mean by that is the PE ratio is at a very high level. The highest we've seen sort of coming, except for that short period of time after COVID, before we had the drawdown in 2022.
Yeah, that's when earnings happen, yeah.
Yeah, and so what that's telling us is that consumer sentiment is high. The market's expecting a lot of growth to come over the next couple of years. And we're priced with some pretty strong expectations and at a pretty high level, which means there's more risk in the market as well today.
Right. We don't have the graph, but last quarter we showed a graph on Cisco stock. And Cisco, I remember being in the business at the time, and Cisco was like the NVIDIA of the day. Everybody said, boy, you don't want to go out and try to buy internet stocks. Buy the company that makes the picks and shovels. And that's the networkers, or the networking, the hubs, the switches, and the routers, and those types of things, which Cisco does. Cisco got to a price-earnings multiple, price to sales of 60 times, which is just an incredibly expensive stock. But the thesis behind Cisco was absolutely true. In the last 25 years, their business, based on revenues and earnings, have more than 300% higher. The stock is down how much?
50%. It hasn't even eclipsed half of what it was if you would have bought it then.
So, point is that you can have a great company. I tell you, it's so frustrating as an investor because you have a stock. Like I bought Tesla in 2019, and I thought, crazily that. I saw the charging stations that they had, and I said, electric vehicles are going to be great, and everything else was just getting crushed, and Tesla was going the other direction. And I decided, hey, I've got a rule. I'm going to sell half when I make 200% of my money.
Okay.
So I did that, and then it went up 1,000% in a year, and you're like, oh, why did I sell? I'll never sell, and that's kind of the rule that you have in yourself. This is a special stock. Well, there's no special stock. And so having to rebalance and take profits is such a tough task. We sold a chunk of Apple.
Yep.
And it's because when you look at when we bought it, it was trading at like 15 times earnings. It was a smaller company. Earnings were growing at 20% a year. Now the stock's at 32 times earnings. It's an enormous company, and the projections are that the earnings are going to grow at like 12% a year.
Yeah.
So you're paying more and getting less growth. And again, you can't have a tree that grows completely to the sky. So you have something called portfolio drift. So you rebalance the stocks, which unfortunately requires you to pay some taxes. But you also need to rebalance your portfolio. So Jake, I'm going to slide this next slide and walk us through what this shows us.
Yeah, so this is a pretty interesting graphic. If you look at the left-hand side, it goes from 2019 to where we're at today. It takes a 60-40 portfolio, and that's 60% in equities, 40% in bonds. And what this analysis does is it assumes you don't rebalance your portfolio.
Right.
You just let it ride over the last 5 years and change. What does that do from an asset allocation standpoint? Well, we know that especially growth stocks, US growth stocks, have done extremely well since 2019. And just that allocation would have drifted from a 60-40 blend to about a 75-25 blend. And so that risk profile is immensely different than the 60-40 is.
Absolutely.
You have way more equities, not a lot of bonds, which are really that ballast of your portfolio. And so looking forward, that's obviously worked out over the last 5 years. But will it continue to work out over the next 5 years is something we would be much more concerned about.
History says not. And if you do rebalance, then when you have a market correction, you have the cash that you need. If you're a retiree and you need income from your portfolio, you absolutely need to be rebuilding those bond ladders now. And also, your bond returns are almost 100% correlated to the yield that you get when you buy the bond, because that's a bond, right? You buy a 5-year bond at 5%, I can tell you're going to make 5%. And we're now having bonds in the 5% range, whereas a year and a half ago they were at 0.5%.
Sure.
So bonds are going to be yielding more. We used to say there is no alternative, Tina, and now there is an alternative. It's called the gold government bonds. So anyway, the point is that be prepared to rebalance your portfolio. We're doing it automatically for a lot of our portfolios, but talk with your advisor if you haven't done this. Pay the tax. Don't let the tax tail wag the investment dog. The other thing to be thinking of is just because the market is high, doesn't mean that every stock is high. And what's happening is we've got 7 or so stocks that are really overwhelming the rest of the market. They're called the Mag 7, Jake. What does that refer to?
Well, yeah, of course, if you think about the S&P 500, what many clients might not know is that this index is market cap weighted. And so what that means is, you have 100 slices of the total pie. The larger companies take up a greater portion of that entire pie. And so as Scott was talking about, these Mag 7, these 7 big companies like your Apple, your Amazon, Nvidia, Microsoft.
Netscape.
Netflix.
Not Netscape. Netscape's gone.
All those 7 companies are representing an enormous piece of that overall pie. And in fact, the top 10 companies in the S&P 500 are representing over 35% of the weight of that index. And so what that means is that more and more of the return is being driven by those top 10 companies. And what we know about those 10 companies is that right now they're expensive from a PE standpoint, especially versus the rest of the 490 stocks in that index. But also those 10 companies, they're highly correlated with one another.
Right.
Some of them are suppliers to others, like Nvidia is a supplier of GPUs to these hyperscalers like Amazon and Meta. But also you could see that when one of them pulls back, the others tend to follow. Like we saw with DeepSeek causing Nvidia to pull back. All of the other hyperscalers and major large companies of the index were also down too.
Right.
And so you have a concentration risk, you have a valuation risk, and now you have a correlation risk as well. And what we see within the other 490 stocks in the index is they're trading at a much more reasonable valuation. From a PE perspective, they're currently trading at 18 times earnings versus the top 10 companies in the index at almost 30 times earnings. And a lot of these companies are growing strongly too. Mm-hmm. Not to say that the top 10 are not growing, because they certainly are, but these are some of the risks we're starting to see within the equity market.
And you have really 2 schools of thought. One school is that these technology stocks, nothing's changed. There's never anything new under the sun, as Solomon would say. And you have a bunch of spending in technology, but that spending goes in waves. Once everybody gets their new GPUs and they're able to do the processing, that's off to the side. The other school of thought is saying this is different. AI is the Moore's law is being thrown out. That's the speed in which, or the size of the chips and stuff. But the speed in which AI is progressing, it's exponential.
Yeah.
And the demand for the infrastructure is going to continue to be strong. And we haven't yet felt the impact of AI in the economy. So we had this period of time where workers lost their jobs through robotics and technological innovation. It takes one guy with a remote control to pick cotton, whereas 150 years ago it was 200 people. Today we've got a lot of people in jobs like legal secretaries, paraplanners, you name it, anything that takes data, organizes it, does some analysis, writing, graphic design, you name it. I mean, film. AI is a huge help, and it's going to have impact on the demand for workers. So if that happens, obviously you're going to have a lot more profits, because they're able to get rid of one of their major costs. So there's two edges to this sword on what's going to happen in valuation. So we're at the point now where we don't want to make big bets. We don't want to say sell everything because things are overvalued and all these things, or my gosh, this is the brave new world, let's stay invested and get invested. We have to have our rules and let the assets grow in a controlled way. This is the tech capital spending, Jake, and this is really getting to the projections of what the economy thinks, or at least Wall Street analysts think is going to be spent in technology in the next, say, 3 years.
Yeah, so this chart's pretty interesting. If we look on the left-hand side, it's looking at capital expenditures from the major AI hyperscalers.
Yep.
So that's Amazon, it's Alphabet, it's Meta, it's Microsoft, and it's Oracle. These are kind of the big ones that are spending on the next gen GPUs to really do this AI inference training and language models. And what we see there is the dark gray is kind of what's happened in the past. And we could see a nice uptick in growth there within capital expenditures. But what's kind of that other edge of the sword, as Scott was talking about, is continued growth. And that's what analysts are pricing in over the next 3 years of significant increase in CapEx from these businesses, mostly around AI projects. And we've even seen that in the last couple of earnings calls from Amazon, from Alphabet. They're doubling down on their investments and saying that they're not slowing down anytime soon.
And yeah, that was the scare of DeepSeek, is that they can get better AI with less power, less chips. I don't necessarily believe it, but that's what the Chinese are reporting. So when you start wrapping this up, there's one more thing we want to talk about, which is getting into the diversity of the portfolio and the impact of what we call alternatives. So we're talking about this a lot with our clients, and the way I like to describe it is, if you're going down to Publix, which is our local supermarket, you have the aisle of stocks and the aisle of bonds and the aisle of cash. In the aisle of stocks, you know every stock that's in there, and you can use your card or a mutual fund. And in the aisle of bonds, and then you got this other aisle that's really enormous. I mean, it's twice the size of any other aisles, and that's called alternatives. And there's just a wide variety of things with different objectives and different purposes. It can be everything from real estate to gold to Bitcoin to commercial real estate to hedge funds to private equity to venture capital, buyout funds, you name it. So it's a big, long space and includes things like private debt.
Yep.
So what are we looking at with this graph, Jake?
Well, what this does plainly is it looks at the bubble size is the yield on the asset class. And so, for example, private equity, a very small dot. You're not buying private equity to generate a lot of income.
Right.
You're doing that to enhance returns. Whereas on the flip side, with direct lending, and that's private credit, a large bubble there, getting a lot of current income. And then what we also see here is on the x-axis at the bottom there is correlation to your traditional 60-40 portfolio, that's stocks and bonds. And what you want is lower is better, and negative is even more better for your portfolio. That's a technical term for it. And so, for example, U.S. core real estate, really at the bottom left of that chart, a pretty good bubble size. So you're getting yield, you're getting correlation benefit, and you're also getting inflation protection with that asset class. These are the building blocks that we look to bolt on to portfolios to make them what I would call all weather. And what we do is we take a look at the asset class, really try to understand the fundamentals and the driver of risk and return. And then we look for really great providers here and really great fund managers. And so where we're at now is we have good options for clients who want to enhance returns while also reducing correlation to the equity market. Well, we would look at private equity to fulfill that need. Income, diversification, and yield, we would look at private real estate and direct lending. And so these are things that we believe our clients should be thinking about because they allow for a much more smoother ride as the liquid market fluctuates on a day-to-day basis, and we've seen that happen more and more this year.
But you have to be really careful because there's a lot of I don't want to say questionable things, but things that I just wouldn't invest in and won't invest in with our client money. And so you look at private equity and private debt especially. There's a lot of product that's being out there, but if you get something that's registered with the SEC from a vendor that's got a good reputation and a long history, it still doesn't mean you need to pile into it. So you have to have things in proportion and know what you're getting into and know why you own it. But you certainly have an opportunity, like for example with private debt, some of those are paying 10%. And you look at the risk that you'd have to take in the stock market, for example, to get a fairly predictable 10% return, and the risk is not nothing. So should you say that I don't want to invest in something that pays me 10% because it's got risk? No, you just want to keep in mind that it's got that risk, but it needs to fit into the portfolio. So I'd like to think about, a healthy portfolio is like a healthy dish of food. You might say, gosh, Jake, what's the best food for me to eat? And you might say, carrots. And so I sit down and have nothing but carrots, breakfast, lunch, and dinner. It's not going to be healthy.
Right.
So carrots might be very good, but you want them as a part of your plate. You want even some cranberries that are really tart, but it adds some zest to the portfolio. You want your big turkey and potatoes, and it's just like that with the portfolio. You want your quality stocks and bonds, and you want to sprinkle in some of these alternatives to get your portfolio. It's kind of like the fertilizer of the portfolio. So that kind of gets us to our wrapping slide, which is what we call stay. And we like to, this has got a couple different meanings. First of all, STAY stands for strategic, tactical, adaptive, and yield focused. I'll start with yield focused. So we think the yielding part of the portfolio, the high quality bonds, dividend paying companies, certain types of private debt, infrastructure like MLPs and oil and gas pipelines, that type of thing, really a good place to be, because if we have a flat market, you're making that yield. What do you mean by strategic, Jake?
Well, strategic is the guardrails that you have around your portfolio allocation. And these are the rules that you have over the long term. We know that over the long term, you shouldn't just be in only equities. That's
right.
Like only eating carrots, as Scott just mentioned. Don't stray from that. Don't get worried or spooked by one thing and allow it to derail your strategic allocation.
And tactical means there are some shifts that we would recommend. So we are taking profits in some of the tech stocks that have been so wonderful to us. We're buying some of the dividend paying companies. We're looking at areas in small cap and international that are pretty attractive. And then adaptive, we have to adapt to the changing marketplace. So there has been something that's been very real, which is the technology in our industry has advanced, and it's allowing investors to get access to investments that they didn't have before. So before, we could get a perfectly diversified portfolio with stocks and bonds. Now I think you need to be a little bit more adaptive and bring in some of these other asset classes. Commercial real estate's a great example. You can get a nice 6% dividend. Most of that dividend you're not going to be taxed on. And as an asset class, it does go up and down, but not nearly as much as you would see in a stock market or even the bond market. So to wrap things up, I hope you got a lot out of this. STAY is our acronym, that you want to be strategic, tactical, adaptive, and yield focused. And then also remember adaptive trellises. So we want to have our rules-based approach. We got to adapt to the current environment. Think about the base case in our street signs, which is not overly optimistic, but be ready to shift to get more defensive quickly or more offensive quickly as the data comes in. So far, the data on inflation has been negative. The data on the economy has been positive. God bless, and let us know if we can be of any assistance to you and your family.